Today on the show, I have the pleasure of chatting with a very good friend of mine, Omar Khan. Now, Omar is the founder of Boardwalk Wealth, a multifamily investment firm here in the United States. And Omar is also a CFA, and has over 10 years experience investing across real estate, commodities, and has an M&A background advising on over $3.7 billion of transactions in his former life before jumping into the syndication world. Omar is a self-proclaimed global citizen like myself, and he's lived in Dubai, Toronto, Calgary, and Dallas. And for all of those who have listened to this show for many, many years, you would know that Omar has been on this show before. I encourage you to go back and listen to that earlier episode way back in the day. But I'm really pumped to have him on the show today. So enough out of me. Let's get him out here. G'day, Omar. Welcome to the show. How are you today, mate?
What's going on? Finally, we get to talk. I mean, we talk and text all the time, but on a podcast.
We get to talk on a podcast. Yeah, I know. It's really good, my friend. And you just closed on a new deal in Gainesville, Florida?
Yeah, no, Gainesville, Georgia. I closed on the deal, Georgia. But I think I've reduced my life expectancy by at least like 5% just in that process. Man, it ain't easy, Chloe. It's not all sunshines and rainbows.
That's right. That's right. And we'll get into that in a little bit. But for those of you who don't know who you are, can you rewind the clock and tell me how you made your first ever dollar as a kid? And then we'll get into your story about what you built to this point.
Okay. So I think, because I don't remember every single detail, I think the first dollar I made was, I used to play keyboards when I was young. I honestly don't have any musical talents. I don't know, maybe I had it for like a 5-year window in my life. Right. And I loved the synthesizer. I love music. I loved 80s music. Right. So I used to play, and then I gave some music lessons for a couple of months. And that's how I made my first dollar. I am still surprised anyone took music lessons from me. But hey, got $1. That's not too bad.
And that's awesome, man. And you have a global background. So where you're from, where you're born, where you're brought up in, and what brought you to the States?
So I was born in Dubai. I grew up in Pakistan. I went to school to Canada for a few years. I thought I was going to go back to either Pakistan or Dubai, but that time, I just stuck around. I had a girlfriend at the time, not with her anymore, thankfully. Got a job, did that for a few years in Toronto. One of my bosses poached me to go to Calgary because this was in the height of the oil boom, right? So it was fantastic. You would think like everybody was walking on water. Not without realizing it wasn't us. It was basically the oil market, right? So that was a really fun few years. Learned a lot, met a lot of interesting people. Then I met my wife. She is a physician, or she is still a physician, but she was in residency training in the US. And it was a toss-up, when we got engaged, we started talking, whether she comes up to Canada, I moved down. And for her to move up to Canada is very bureaucratic, right? So for her to move up, she'd have to pretty much do everything. And she was in the last year of her residency. So this means she was done with medical school. She was done with her training, pretty much the last year of her training. And for her to go to Canada, she'd have to start pretty much from scratch again, which is, I was never going to put anybody through that type of mental torture. Right. So, and for me being a finance guy, it was relatively simpler to move down because you don't really need a license. You just need good networking and all those sorts of abilities. So we just packed our bags. I lived in upstate New York for a few months. Do not recommend it to anybody at all. And then
whereabouts?
Syracuse, man.
Yeah, that's right.
I was PTSD from living in Syracuse, right? And then I moved to Dallas. And, that's how we started. We started doing the typical finance stuff. We had a tax problem we wanted to solve. I had a good personal and professional background running deals, all of that sort of stuff. Did our first deal, partnered with you as well on a couple of deals, did a couple of those. And then just, one foot after the other, right? You do one deal, then you do another one, you do a couple of developments, acquisitions. And a few years later, you're on the podcast with Reed Goosens again.
Well, mate, I've been observing your growth for some time now. And maybe just give us a summary of what you've been involved with, because I know personally what you've been involved with, but maybe for the listeners, you not just the run-of-the-mill multifamily, you've got some other things going on, other sort of prongs in the fire, so to speak.
Look, so, my family, I'll give you a background. My family is a business family, right? So we've always owned a lot of commercial real estate. It's only when I started actually doing a lot of real estate deals did I realize that the traditional path is, you do houses or whatever, townhomes or whatever, and then you kind of go up. And maybe like my dad or my grandfather did that, right, back in the day. But by the time I was around, we had actual commercial real estate that was either, it wasn't a running company, it was more investments and holdings and that sort of stuff, right? So for me, I was never really down to the, hey, get houses and kind of go down that path, because it just wasn't really something I was either used to or exposed to or didn't want to do. So I always saw real estate as a means to an end, right? Hey, it's a great business. You meet so many great people, but it's like any other business and you've got to treat it like a business, right? So real estate was one thing, but coming from the finance investment banking world, I was exposed to a lot of other businesses. And then just through my network, family, friends, otherwise, when say you're an entrepreneur, right? Mm-hmm. Now, a lot of your friends now are entrepreneurs and they're doing lots of different things. So once you're in that environment, you start getting exposed to a lot of people, whether your family's an entrepreneur. So I just knew a lot of people with different businesses and they were very well-to-do people. So for instance, I started looking at other businesses. Hey, my real estate business development and acquisitions is going really well. What other businesses am I looking at, which are good, sustainable, long-term cash generating businesses? So now we're in the QSR space. We're going to launch, QSR is a politically correct word of saying fast food restaurants, right? Mm-hmm. So quick service restaurants. So we have the rights in Florida for a health food chain, and we're opening locations there. But again, the reason why I could do that is because it's a very operationally intensive business. One of my really big investors happened to be the COO of one of the biggest private equity-backed franchise-owned chains in the Southeast. So, once he came on board, he started investing with us. You meet people. I just started talking to him, learned what he was doing. I had done a lot of research, coincidentally, into the QSR space because about a decade or about 12 years ago, Tim Hortons, which is the Canadian Dunkin' Donuts, it's a national institution. You probably know about Tim Hortons, right?
I do.
Right? Yeah. Tim Hortons got acquired by Restaurant Brands International, which is a global private equity firm, right? It's run by a couple of Brazilian guys. Jorge Paulo Lehmann is like the head honcho there. And they had acquired a Canadian national jewel. Now in Canada, it's a pretty big deal, right? I mean, the US, nobody really cares, right? And it was a big uproar in Canada. How could a foreigner buy this? Blah, 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 blah. And I got curious, so I started, because I was an equity analyst, I started going through the company's financials and started seeing, okay, how do you operate it? Because a Timmy's is pretty much on every corner in Canada, pretty much. You cannot throw a stone and not hit a Timmy's. It's that sort of deal, right? And there's always a line outside the door. So I realized, analyzing that business, wow, it's operationally intensive, but holy moly, these cash margins are crazy. I mean, once you nail it, this is like a money printing machine, essentially, right? So I kept that at the back of my head. I met Thaddeus, who was the CEO of this private equity-backed firm. He was on the way out. And him and I started talking. And that business relationship blossomed, and now we're doing all of this stuff.
That's awesome. That's awesome. When can investors find out about that?
So you can go to our website, boardwalkwealth.com. Right on the front page, there's an email opt-in, name, email, and guess how you found out about us. Click on the button. I don't even know what it says. You'll be sent an email. You verify that, and I'll know when you're on my mailing list, or you can email me, Omar at Boardwalk Wealth. But the bigger point there was, as you and I were discussing, I was looking for a true diversification business outside of real estate, right? Real estate is a very capital intensive business, right? You have to have a real estate, you got to put money in it, right? And I wanted, as a secondary business, like a complement to my real estate business, a business that wasn't capital intensive, but operationally intensive, brain power intensive, right? So, because for me, that was true diversification. Because if I had to keep throwing money at something to solve a problem, that's not a good long-term scalable business, right?
Yes.
So that's why I looked around for a lot of times, found the right team, because that's very important to have a right team of experienced people who knows everyone. And then we went all in, basically.
That's awesome. I'm looking forward to finding out more about that, because I'll personally be investing in that coming up here soon. But mate, let's pivot to the genesis of today's show. You and I spoke a little bit offline. You have a lot of curious thoughts in and around inflation, in and around capital raises, in and around how to pay zero taxes. So today's show is going to be all about really all three of those topics. So maybe let's start with inflation and interest rates and implications for 2022 and beyond, and where you think we're headed, given your background in the financing markets, M&A, and what you're seeing across the globe.
Well, you don't need to be super intelligent, Reid, to know inflation is happening, right? It's real. It's happening. But I think a lot of people, in my opinion, get really hung up on, it's happening, the world is ending, and then they stop. right? And you're like, look, unfortunately, I mean, we don't have the ability to, most of us at least, don't have the ability to do anything about it. So what we can do is proactively plan or at least react in some shape or capacity to position our portfolio to take advantage of it. Because that's the only thing in our control. Like worrying about inflation isn't going to help you because there's no way around it. So inflation, unless the Fed actually follows through on what they say, they violently raise it, and violently, I'm very carefully using that word, they violently raise the rate of interest, right? Way above what they've guided, and then they just stick to it, right? Because they tried raising the rate of interest a few years ago. The whole market went into a meltdown, and then they just kind of backtracked with, right? They no, we didn't really want to do that, right? So now it all depends how much, basically, for the lack of a better word, grit do these people have? And that's basically the game you're playing right now as an investor. Like, does the central bank have enough of a political and other backing to withstand this? And in a polarized, marginalized world like we have right now, the fact of the matter is, even if a central banker wants to do something, right, like the right thing, quote unquote, whatever that means, they might not have the political backing to do it, because the political will to do it might not exist. So what we have to do as investors is realize inflation is here. It is going to be happening for the next few years. There is no other way around it. There's no use to bitch and moan. So what we have to do is position ourselves in assets and investments that will positively benefit from this. Now, real estate is one obvious hedge against inflation, right? Because it's a real asset, so your value keeps getting valued upwards in real terms. But you as an operator also know that we can basically take up rents because our leases are, say, 10 months, 12 months. So every 10 or 12 months, we can jack up our rents to accommodate the increase in inflation. So that way we can manage that side of the book. But that's not the only game, right? The other game is to actually be looking at basically investments right now that can give you, say, 10, 12% cash on cash on a very on a sustainable basis. Not, say, a sponsor saying they're going to give you 10, 12, they come over 3 or 4 at the end of the year, right? And there you kind of have to be in operating businesses, because only in operating businesses where you're not encumbered by many fixed costs, right? Your fixed costs don't drag you down. Do you have the flexibility? Because look, think about it this way. If you have to spend $100, right? And 80 of that is fixed costs. Well, regardless of which way the market goes, you're SOL, basically, because you've got to pay 80 every month, right? But if you got to pay $100, but 80% of that is, say, your variable cost, so you can adjust to the way the market is going, that puts you at a competitive advantage. Because a lot of times you can devote more resources knowing that every dollar I spend here is going to give me a multiplicative effect, right? Yeah. So you have to be, by design, in businesses, apart from real estate, that are operating businesses that have a low fixed cost ratio. That's just the way it is. You have to be nimble. And that's why, for instance, when I was talking about the QSR business, that is a business where we're not going to own the underlying real estate. You lease it, and the lease terms are set 5 years and 10 years, right? So the annual rent escalators, and you're going to laugh at this, are 2% a year. I mean, dude, we are raising our rents on our properties by like 15, 20, 30% at times.
Yep.
So this retail guy is going to lease me something, and all he's going to get is a measly 2% a year. I mean, I'll take that trade all day, every day, right? So that's basically it. I think a lot of people get especially in America, because Americans have had, by the grace of God, such a good run. I mean, it is the apex country, right? That people aren't used to a lot of gyrations happening at such a quick pace, right? And when they start happening, people freeze and they don't take any actions.
And when you talk about gyrations, you're talking about this, everything's costing more, rent's costing more. Yeah. Petrol's costing more. Groceries are costing more. That's what you mean by
gyrations. And I like how you still say petrol, by the way.
Gas, yeah, gas.
I say petrol as well, by the way.
No, but so how much of your portfolio and what you're seeing with your investors is in an operating business like a QSR or versus real estate?
Very, very, very less. Because the reason is the barriers to entry into getting into operating businesses through private equity, right? To take away real estate is very high, because traditionally it's been reserved for institutions, say, or people who would swing like a $5 million check.
Yep.
Either that, or say your brother-in-law's opening something and he asks you for $50,000. But sure, there's nothing in the middle, right? Say you're a rich doctor, you're a business owner, accountant, you got a $100,000 check. It's either real estate, because, that's a big business, or the stock market. And the in-between part is it's an accessibility issue. And that's not been, a lot of people aren't exposed to it. And they're going to find out the hard way that if you're not exposed to things, the right things, that can cause a detrimental effect on your portfolio going forward.
But back to the question is, are you seeing like an 80-20 split with an operating business investment in a portfolio versus real estate, or is it more 50-50?
Oh, dude, I'm seeing more like 99-0. People aren't even exposed to it at all.
Okay, so you're just saying everyone's either in the stock market or in real estate, not in this sort of QSR type of
because accessibility is the issue. Straight up, it's accessibility is the issue, right? And the funny thing is, at least for my investors, because when I tell them, hey, this, you talk, right, with all, at least your favorite investors, you talk, what's going on, and I tell them, hey, this is what I'm doing. Every single one of them have told me, here you go, man. Just let me know when you want me to sign, where you want me to sign, because because once you tell somebody, they immediately put 2 and 2 together. Right. There's no going back after that. You can't unsee it.
Well, but let's talk about then inflation then, and how is a business in hedging against inflation versus a physical asset? We all know, and we talk about on the show, physical assets are hedged against inflation. That's why people are investing a lot into commercial real estate, because we get to depreciate things. But when you're in an operating business, you don't owe the underlying dirt.
No, pricing is the biggest driver you have. So for instance, this health food chain that I was talking to you about, this literally, if you are going to laugh, when you get introduced to the brand, you come in and, they do the whole welcome day orientation. They have demographics, and the demographics clearly are, and people laugh at this when I tell them, $110,000 plus median income, college educated, soccer moms. That's it. There's no other demographic, because the reason there is that if you're on average making 110, again, because this is very different than the Taco Bell demographics, right? Or the McDonald's demographic, where it's just a race to the bottom, right? 99 cents, 40 cents, 2 cents, 0 cents, right? This is basically, you have pricing power. So for instance, if a soccer mom that has 110,000 college educated soccer mom that has $110,000 median household income, if they're buying something from me for $7.50, and inflation goes up by 10%, and let's say you might pass it all on to the consumer, it doesn't hurt them as much because they have enough pricing power. So even within private businesses, you have to realize which segment of the private businesses you're in, right? If you're in, say, the price competition where everything's made in China and it's a price to the bottom, inflation is going to destroy, because you have inflation pressure, pricing pressure, competition pressure, you're going to kill. So very commodity heavy businesses, they don't tend to do very well in these certain situations, basically. But when you've got niche products where you have pricing power as a producer, that's where you can really crank the screws, basically.
But I would assume that you'd have to also have scale, right? Because you can't, the risk of having 1 or 2, stores.
Yeah.
Is that you need to build a brand around it, because
So in this case, it is a franchise that has 140 plus stores.
Got it.
So so it's like, say, think about it this way. You know how when Walgreens orders drugs from manufacturers, it's not like the Walgreens around the corner from wherever you live. It independently orders drugs, and the Walgreens where I live independent. No. They combine all their purchasing power at the top at Walgreens holding company. And then they go to, say, a drug manufacturer and say, look, we're going to give you $80 million this month. Give me a 20% discount. Right? So you're right. You need scale. And that's why when we were looking at these concepts, we didn't want to go to a brand that was very small, like, say, less than 50 units. But we also didn't want to go to a brand that was over 500 units, because when you get into that range, you're either in a price competition, because now they have to cater to everyone, or the price of entry is so high that it's just stupid. So I'll give you an example. With this one, our price of entry is roughly about $350,000
per store.
Per store, because we're not owning the real estate, right? It's just, this is basically 350 to 400,000 is, I give you, Reed Goosens, 350 to 400 grand, and you give me the keys to a store that's up and running and ready to accept the first customer, right? Now, in this model, because this is a newer set of models, your average unit volume, which is, say, your gross potential rent in real estate terms, that is at least $1.5 million. It's $1.2 to $1.5 million. So think about it this way. At the low end of $1.2 million, you divide it by 400,000. So it's a 3 multiplier on your investment, just on
per
the
year.
Per year. Yeah, yep. Per year, right? In a McDonald's, what happens is you are out of pocket $1.5 million to $2 million upfront because it's a standalone location and you got to do all the bells and whistles. And your first year revenues on average are like 1.75 to 2 million. So your ratio is very skewed because again, why? Because your fixed costs are so high, right? McDonald's is standalone. You got to have the big sign. You got to go do this. Those types of businesses are not nimble, and that's why a lot of those businesses get killed.
I would argue that McDonald's, you're buying also the brand.
Oh yeah, I mean,
so there's a brand element to it.
Yeah. Look, hold on. But you have to look at it over a long-term scale. My point is, your payback, your investment payback, for McDonald's is more like a 5-10 year play.
Correct. Yep.
But again, the deal there is that that's something that is your primary line of business.
Yep.
Like if you're a McDonald's operator, you're not doing McDonald's operations and kind of moonlight trying to wholesale houses, other things. Right. But when you've got a 350, 400 grand unit, what you do is you build out 5 of these for every one McDonald's, and you make it up basically on margin and volume, basically.
Got it. But who's then running that $350,000 store? Because I don't want to run it. I've got a real estate business.
No. So this is why I told you, right? When I partnered with Thaddeus, the big thing was I told him I was straight up because initially we were looking at some Wingstop, which is the chicken brand.
Mm-hmm.
They have it in California, right?
Yep, they do. Yep.
Yeah. That's another great brand, by the way. They're going through a bit of an issue, but it's a great brand. I told him, look, man, if you open a Wingstop, I'm not going to fry the chicken wings myself because you really don't want me doing that. So this is why having a good operating partner was very critical for me in this whole piece. It took me about 1.5 years to do this because I went to Thaddeus. He knows all the people in the industry. We picked up this great operator that actually worked underneath him. He was his director of operations. And his deal was, like a lot of guys who are in these niche industries, is that they made a lot of other people money, but they never got an equity share in the business. And a lot of the smart operators, in all businesses, by the way, they realize eventually, hey, if I don't get equity in this business, I'm just another guy. And I'm going to retire at 60, and that's it.
Mm-hmm.
So with him, basically, I interviewed a few people, and my whole deal from day one was, look, you've got to be at least 45, 50. So in my mind, the idea was you've probably been burnt by a few people before, right? Because people make these lofty promises and never follow up, right? And because you've been burned before, you also see in the next 15-ish years, 10, 15 years, you're going to retire. So you're in that sweet spot where you've got the right amount of experience, you've been burned before, and now you actually understand the power of having equity in a business and helping it grow.
Yep.
So that's why it took me 1.5 years to find the right operator. We've got Greg McPhail out in Palm Coast, Florida, and he's 25 years into the business, knows pretty much every single person. It's really funny. I'm on these calls now, and some CBRE broker will be like, hey, Greg, haven't talked to you in 3 years. How are you doing? You still doing Taco Bells? No, man, I'm in Clean Eats, right? So those connections you can't really buy.
Right.
It's just one of those things you just have to pay your dues.
So pivoting away from just this conversation for a second, looking more into the future of what you think inflation is going.
Yeah.
These are all good strategies in real estate investing in QSRs, understanding where to invest and non-fixed cost versus variable costs in businesses. But what's your crystal ball saying to you right now, Omar, coming into the next 2-3 years from an inflation and interest rate point of view?
I can tell you this. I don't think in the next, say, 1.5, 2 years, I don't think it's going to materially improve. Let's put it that way.
Material improve from an inflationary point of view?
Yeah, from both either an inflationary point of view, well, primarily an inflationary point of view, number one, but also from a point of view of, say, stuff like supply chain issues.
Right.
It's not going to improve because the issue is a lot of people have realized when they bought into this whole just-in-time manufacturing sort of deal, yeah, it's really good if your system is working super efficiently, but one small kink in your system just destroys everything. So now you see a lot of people are moving their factories from, say, China to Mexico.
Mm-hmm.
A lot of people, but that doesn't happen overnight. Right.
It takes time.
Because even if you have all the money in the world, you don't have a warehouse, you don't have a trained workforce. Right. So we're seeing all of these things, and for these things to happen and materialize, it's going to take like a couple of years. It doesn't happen overnight. And I mean, look, the simplest example is we're looking for a car right now, right? Because my parents are going to come. I got 2 kids. We got to look for a bigger car. Dude, I cannot pay people right now money to give me a car. Like, I'm not saying give me the car at list price. I cannot pay $10,000 to $20,000 over the list price and get a car right now.
Yeah.
That's how crazy.
First time in history where cars are appreciating. The average car.
Yeah, the average car. I mean, and not only appreciating, you can't even find it.
Right. That's right.
If you wanted to, you can't. So in the next couple of years, these things aren't going to improve. So what you have to do is position yourself in a way that you take advantage from some of these distortions.
Got it. As we pivot now into the tax talk, talk, right? We've talked about inflation. So everyone's worried about inflation. So they're trying to hedge their investments and their money that they have into inflationary hedge investments like physical assets. What else are you seeing in terms of, how you're going to pay like next to zero taxes by investing in a physical asset like real estate or an operating business like a QSR?
So look, the first thing you've got to start is, and I mean, you know this, hopefully you're not paying any taxes, Reed. Come on.
Very low here in California.
You're one of those rich fat cats. Come on, you don't pay any of those taxes. Look, a lot of real estate people get it, but I've seen a lot of people outside of real estate don't really get it. A lot of times, you could be making, let's assume $1 million a year, right? And let's assume your average tax rate is, we're going to keep it simple, 40%, right? Mm-hmm. So this means make $1 million, you pay 40, your take home is $600,000. Right? Now, a lot of people assume when they're doing their budget, they just start at $600,000, right? They don't assume that they can do anything about their tax position,
right?
Because, hey, I don't even see the money, so what can I do? Well, the thing is, you can do something about it, because when you tilt and position and again, this doesn't happen overnight. It takes a little while, right? When you tilt and position your investments towards tax efficiency, right? For instance, when you're doing real estate, you get all these depreciation write-offs. Now, you could say I'm a passive investor. How do I take it against my active income? Well, a lot of times what people have done is, a couple of my investors have done this, where say one of the partners was making significantly more money and the other partner wasn't making enough. And in this case, they had a couple of kids, right? So the one partner can decide to stay at home. This other partner who's making more money, instead of say investing more in the stock market, started heavily investing in real estate. The benefits of those tax write-offs now, because the partner that's staying at home also now is doing some stuff to qualify as a real estate professional, right? So now all those tax write-offs can be taken against active income to actually help people out. So like I said, it doesn't happen overnight, but when you start focusing on tax efficiency, what you start realizing is that you can do something about your tax position. So think about it. No job, at least to my knowledge, is going to give you a 30 to 40% increase in your paycheck every year on year, for the rest of your life. It's just not going to happen. Okay, that doesn't exist, right? But if you manage your taxes properly, and let's assume you take your 40% in taxes to 20% in taxes over, say, a 5-year period. Well, that's 20% you get to keep in your pocket. That's $200,000 in this case for the rest of your life. Think about it. If you had an extra $200,000 a year, or you have your tax bill, let's assume you pay $100,000 in taxes. You have it. You pay $50,000. You keep $50,000 a year. That pays for extra mortgages. That pays for private school education for your kids. That pays for vacations. That pays for savings. I mean, Jesus Christ, man! It pays for pretty much every single thing you are stressed out about.
Oh, that's right. Yep.
Right. So if you're not tax efficient, and by the way, it's not just in real estate. Oil and gas leases, you can get a lot of write-offs, even 100% in some cases. Right. So you have to start focusing on tax efficiency, because if you don't focus on tax efficiency, it is leaving money on the table, essentially.
Yep, no, that's right.
All the time, every single day.
When you're living in a state like California, it has higher tax rate. So trying to offset that tax efficiencies is so important. What other things? You mentioned oil and gas leases.
Yeah.
Have you heard of the conservation easement stuff?
Yes, but the IRS keeps cracking down on it, man. So I'm really... That's what I've heard.
Hesitant. Yeah, no, I've heard the same thing.
I've always been a little hesitant about it.
That's right. No, but you're completely correct. The way in which both of us as syndicators, we position it to our investors is you have to be more tax efficient with your income, right? The reason you invest passively in our deals is so you can benefit in being involved in a physical asset. And I don't know what you're seeing, but I'm seeing a lot more people focusing on the tax efficiencies these days coming into this inflationary environment rather than the cash flow, because historically multifamily has been fantastic for cash flow, but with inflation, prices are skyrocketed. Rents are still having to catch up. Cash flow coming out of the gates, plus is a lot lower. Plus compressing cap rates. So I think having a good, balanced, diversified portfolio, like supplementing it with a, say, QSR, is really, really important. So you get the benefits of both worlds, the tax efficiencies in the physical assets and the cash flow from an operating business. And you also get cash flow from
to your point, again, there is no one pill, there's no one magic pill, like you do this and all your problems will solve. A lot of this is basically having the awareness to realize that there are solutions to problems, but if you don't even consider something to be a problem or don't acknowledge it's a problem, how can you go solve it? Right? So if you never even acknowledge your taxes as an expense, because if you think about it, it is an expense. I mean, you made money and you don't got it, right? Mm-hmm. So it's an expense. If you don't take that first step and realize it's outflows, hey, just do this in your head. I make this gross income. What are all the outflows leaving me? Doesn't matter what it's called. Just realize what are the outflows. Once you recognize that problem, you can then go solve it, basically.
Yep.
Or get on the path towards solving it.
Completely agree. And there's also other ways of doing tax efficiencies in other physical assets like commodities, cryptocurrency to some extent, but there's volatility in that. But you have to also understand what's the best use of your money. So, commodities
and time also, by the way. Because a lot of times you can do things, but they might be very time intensive.
That's right. So one like gold might have really good hedge against inflation. It's also good for tax benefits, but it's not going to produce any cash flow, right? Yeah. Physical real estate has the benefits of all of that. Operating business may not have as much tax efficiencies because it's not physical. It's just an operating a business. So having your prongs in the fire for a diversified portfolio is really, really important. And all of these things are outside, the conventional investing in the stock market. So there's a lot of places for people to place their money, and it's just about being educated. And to your point, unless you acknowledge that something's an issue like taxes or like cash flow, and you don't focus on it, then it's you're never going to be able to fix it. So let's pivot to the sort of the final thing we're talking about in the green room before coming on this show. And that's, how capital raisers are treating high net worth individuals as like walking ATMs. Do you want to give me your 2 cents on that?
Yeah, look, it's funny that, again, you're a sponsor as well, so you probably know a lot of this thing. That a lot of times what happens is you have a conversation with somebody who's obviously either new or like a little green, and then they say, well, this guy's giving me a 30% IRR. And you're like, okay, I'm in the market. I've probably seen this deal, because if you're in the market, you've seen, look, for instance, you're in Central Texas. You've seen all the deals in Central Texas that are being out there. Public, on or off market, right? You're like, look, man.
And nothing's rarely off market these days.
Yeah, right. Nothing is, this, right? Everybody will say, oh, this exclusive off market opportunity or proprietary model or this. There are no secrets, guys. Everybody knows how to do this, right? The real secret is in relationships, but even then, a broker isn't going to give you a deal if you're $5 million less just so you got a nice face, right? I mean, it's just
sometimes faces can do that, right?
Hey, Reed, it doesn't happen with you, though. So. Look, so the thing is, a lot of times we talk to people, both of us talk to people, right? We run similar businesses, we talk to people and they say, oh, this person is doing this. Because the issue you've got to realize is if you talk to 5 people and 4 people say, let's assume it's a 13 to 15% return, right? And one guy says it's 25%, right? Well, the problem is, the guy is treating you like a walking, talking ATM because he's going to get you hot and bothered. You think the number on the paper is some sort of either a guarantee or he's going to get it or some version of that. And we both know that's not true, number one, right? Because above market returns, they're only possible up to a certain level. I mean, it's not like you go from 15% to 300%. That doesn't work, number one. Number two, what's been happening is with the proliferation of all these capital raisers, because they're not operators, a lot of them, they're trying to do in my opinion, they're trying to do a career pivot. So if somebody was making, say, and again, this is not looking down on somebody, somebody's making $40,000 a year or $50,000 or $60,000 a year, and they're trying to pivot, well, the issue becomes, are you the sacrificial lamb on which they're going to go pivot their career on, right? So you've got to be aware of these things because I have so many investors, I know we talk to people say outlandish things with nothing backing it up. And as an investor, especially if you're a newer investor, you will just assume some guy on YouTube, some guy on Facebook or LinkedIn, well, if he's there, he must be saying it. I mean, it must be true. But it's not really true. And by the time you find out it's not really true, the person has your money, it's 2 years down the line, and now you're not going anywhere.
So what are you saying?
So what I say is, first of all, talk to a diversity of people, right? And always realize, it's like what the banks do with their interest, or when they did it when they were fixing interest rates. They would chop off the top coat and chop off the bottom coat, and then they would take the average of the middle, right? Come somewhere in the middle and use that as a baseline. So don't talk to one person, no matter how reputable that person is. Talk to at least 5 or 6 people. Okay, now don't talk to 20, because then you'll be confused all the time, right? Find a middle ground. Chop off the top end of the estimate, chop off the middle and bottom end of the estimate. Take the middle, and then use that to realize if somebody's blowing smoke up your butt or not.
Right. And it's also understanding the risk-adjusted returns. Investing in a tertiary market versus investing in a growth market. You're going to have different cap rates. You're going to have different cash flows. Understanding how the metrics on the financing side work and what levers people are pulling in order to try and juice the IRRs through refinancing or over leverage or mezzanine debt / equity. All these things can hurt and add all risk to the deals. So understanding that and comparing it against a few different operators in some different asset classes also is really, really important, i.e. multifamily versus self-storage, or multifamily versus mobile home parks, or versus office space or retail. Like, where do you think the long-term future is best for your money, to preserve it and to grow it over a long period of time? So I completely agree with all of that. So before we dive into the lightning round, what are your parting thoughts for the average investor listening here today who is, looking at deals that you've just blown them with a lot of information, from taxations to hedging, your inflationary hedges to QSRs to talking about being viewed as a walking ATM? What's the biggest piece of advice for the passive investor out there today?
Look, the biggest piece of advice that I would give to people is, a lot of people get really fixated on the deal. Right? Oh, this deal says 20%, this deal says 18%. Look, in reality, the difference between an 18 and 19% IRR is like a few dollars maybe. It's not even enough dollars for you to buy a burger, okay? But what you really have to figure out, and this is what I do when I'm investing with other people, is I have 2 criteria. The number 1 criteria is, well, they're actually together. Is this person competent? And does this person, in my opinion, share a similar set of ethics, right? Because what you don't want to be with somebody who's very ethical, but a complete idiot, right? Because that doesn't really help you, right? But conversely, you don't want to be with somebody who's extremely competent, world-class, but is a Bernie Madoff, the next Bernie Madoff, because that doesn't help you, right? So a lot of times, we get so used to making these quantitative judgments on an Excel sheet, 18, 19, 1, 2, right? A lot of this still boils down to qualitative analysis, like talk to somebody multiple times. If anybody's trying to pressurize you to invest the first time you talk to them, take a step back. Take 2 or 3 or 4 days. Don't talk to that person. Come back. See if it's a good deal or not. Right? But a lot of this is qualitative analysis, because what you're trying to judge is somebody's character, which again is very hard to do, because if it was easy to do, everybody would do it. That's what you're really trying to understand. And once you have comfort around that, once you understand that, don't even worry about the deal, because if you're dealing with ethical, right people who are competent, the deal will work out. Okay. And no amount of good deal is worth dealing with people whose ethics are either shaky or they're incompetent.
Yep. I completely agree. And it ultimately goes back to that. The person will invest in you as the operator first and foremost before the deal. And it's important to understand who you're getting into bed with and who you're trusting your money with, right? Who's a steward of that capital over the next 4, 5, 6 years. So absolutely love that stuff. Mate, at the end of every show, we like to dive into the top 5 investing tips. You ready to get into it?
Let's go.
Mate, what is the daily habit you practice to keep on track towards your goals?
Oh, so the daily habit is basically, I'm very calendar driven. So for me, as long as I'm calendar driven, a lot of things happen. Also, the other thing is, I've now realized it for a few years. If I basically write down like 3 or 4, like 2 major things I have to do today, right? And because there are always 100 things, right? I write down the 2 major things I have to do today, and I can do them. Everything else happens.
That's a win.
Yeah.
Yep. Love it. Question number 2 is, who's been the most influential person in your career to date?
Look, obviously, the usual answer is your parents, right? For most people, it's their parents, right? Because education, a lot of this starts at home. So I would say my parents. But also along the way, I wouldn't say there's one person, but there's a lot of composite of people who at various stages, they even said, it's even down to the point where somebody said a kind word at the right time, right? And that helped me get through a certain barrier. So there's lots of people. Look, I've had great mentors professionally when I was working in institutions. Keith was a senior of mine. Kent was a senior of mine. My boss, Leo. Now I have so many entrepreneurs. I talk to you. I talk to Jonathan Twombly. I talk to so many other people. So there's lots and lots of people who at various times have either influenced me or said a kind word which helped me get to the next level.
Yep. Love it. Love it. Question number 3 is, what's been the most influential, most influential tool in your business that you can't run the daily operations without? It could be a physical tool like a phone or a journal, or it could be a piece of software that you just can't run that business without. What is it?
I think it's like the G Suite set of like whatever, Google Docs plus the G Suite thing, like calendar, email, and that entire thing, basically. But if I had to pick one, it would be the calendar.
Yep. I do run all my business on G Drive, and it's funny how back in the day, I remember used to working for a small company that actually have a physical drive in the office that they'll save everything on. So it's good to come to the cloud-based system where everyone can access it.
And especially when we're traveling, we can just whip out our phone, quickly see something.
Yep. Exactly. Question number 4 is, in one sentence, what's been the biggest failure in your career? What did you learn from that failure?
Not focusing on marketing enough. I don't know if that's a sentence. That's a sentence fragment.
Yeah.
Okay. Look, this is just my opinion. I think a lot of college educated people, especially in STEM fields or mathematical fields or maybe fields like finance, by the time we're done with college, we end up thinking that, hey, I just have to be really good at my job or whatever I do, and that's good enough, right? That's not really the case life works, because in life, a lot of times it's not the person who is the most competent, it's the person who's probably the most well-known, at least on the face of it, who gets success quickly. Mm-hmm. So learning that there is technical competence, but a good part of now me growing up as a person is the ability to present and tell my story in the right way and be a good advocate for that story. And that is something that doesn't come naturally to me, but it's something that I have to learn.
No, here, and I'm completely the same as you. I'm a mathematical brain, structural engineer, had to learn about podcasting and advertising yourself and telling a story. So I love that lesson. Last question is, where can people reach you to continue the conversation? They want to be in your sphere. Where do they go?
So you can reach out to me, Omar, OMAR, at boardwalkwealth.com. You can also go to our homepage. There's an email option right on the right side of the page. Scroll down, name, email, how you found out about us, click the button. It'll give you access. Click on the link to verify yourself. And if you write in your email, when you email us, hey, if you want to be added to my mobile app, what we can do is just email me. I will have my marketing guy, Sean, add you to our mobile app. We have exclusive video content. All of this is free. For our subscribers, they can get all of this stuff for free. Basically, they don't got to go look around.
That's awesome, mate. Well, look, I want to thank you so much for jumping on today's show. I just want to reflect some of the things that I took away from today's show. I think I really love the way your energy that you bring to explaining something, somewhat complex, like inflation and hedging your bets against inflation to the audience. I think breaking that down into what you need to do to get from point A to point B. I love your analogy about diversification, and not analogy, but what you're now doing to add different prongs to the fire, cogs to the machine in order to supplement and be in other businesses to help diversify your portfolio moving forward. And lastly, how to advise the passive investor on what they need to go out and do in order to look for a good sponsor. Obviously talk to a lot of people, but understand to invest in integrity first and foremost, and the deal actually comes second. So did I leave anything out?
No, I think you covered everything. It's your show. You're the boss.
Well, mate, I thank you so much again for jumping on today's show. Enjoy the rest of your week, and we'll catch up very, very soon.
Thank you very much. Thank you.
Well, there you have another cracking episode jam-packed with some incredible advice from Omar. If you're really keen to go and check him out, you can just Google his name, OMARKHAN, Omar Khan, at Boardwalk Wealth, boardwalkwealth.com, all one word. Check him out over there, doing some great stuff in the multifamily space, but also in the QSR space. So really, really intelligent guy who's got a lot of awesome things to say. I want to thank you all for taking some time out of your day to tune in to continue to grow your financial IQ, because that's what we're all about here on this show. And if you do like this show, the easiest way to give back is to give it a 5-star review on iTunes. We're going to do this all again next week. So remember, be bold, be brave, and go give life a crack.